Zaner Ag Hedge bringing you a strategy of the day update here for September 1st, 2021. I want to begin today looking at that dollar index. It's had a little bit of a pullback here for the Dixie. So some weakness in the dollar over the last 24 hours. Yesterday I was kind of anticipating that snapback reversal we saw on the day's candle to maybe be a test of this 100-day moving average here at 92.52 half last and maybe hold. But today's outside day to the downside so far. I mean, we need confirmation of a lower low here to finish the day off. If we do, of course, snap back up through the day, finish back above that 100-day moving average, this could be an outside day reversal setup too, and really what we refer to as a bear trap. But for the time being, it does look like the outside price action we've seen against yesterday's candle. If we do close lower on the day, have some follow through to the downside, the dollar might be proving a range here between 93 and 90 and be pulling back. And the next level to be looking for support would be a move down towards the 55-day moving average. The 100-day moving average at 91.60. It's the 55-day moving average that's been holding this up here, or that 200-day moving average down around 91.34. We are oversold here in the RSI stochastics. That doesn't necessarily mean, though, that we couldn't continue lower, but pulling back to the 55-day moving average, certainly where we would expect some support. I could draw a little bit of a trend line here from our lows from June through or late June that held in a pullback through the lows of July. A move down into the lower 92s could still be this market making, higher highs and higher lows in some kind of capacity as before we would break out a little bit higher towards 95 to 96. But the truth is that the price action of the last couple of days is still maintaining a little bit of a downtrend off the highs, and you can't ignore there's a bit of a trend line now forming against those highs that we need to be very aware of, that while we remain below that trend line, below the 18-day moving average at 92.92, and certainly now testing below 55-day moving average, there's a pretty good chance that we're going to come back and test the 100 or the 200-day moving averages down here. That area is also basically 50% from the 90 or 89.50 area up to 93.70. 50% retracement would take us back down towards about 91.50 anyway. So we'll see if that kind of technically plays out on this chart. And again, we're concerned with the dollar because we are going into that demand season for the grains. And a rising U.S. dollar represents a lower purchasing power parity for those export partners like China, the European Union, even South America has harder time buying our grain, has to spend more dollars when the dollar is stronger. And that kind of setback into exports this time of year isn't exactly what you want to see. So a weaker U.S. dollar, if this chart falls, gives more purchasing power to those export partners and, arguably can make up for rallies we see in price action on the grain market. However, we're actually seeing the dollar weaken alongside a drop in grain prices here today. It's the start of the month. For the first couple weeks here, first week of a month, usually we see some decoupling of trends like this that we usually are tracking. Some correlations fall apart. So we're going to continue to monitor all of that closely. But the damage that we've seen and the drop in the U.S. dollar is nowhere near the drop in prices we've seen in grains. So we'll continue to monitor that. And by the way, a falling U.S. dollar with a falling grain price right now is going to be very supportive here when we finally do find a low, and harvest lows over the next 2 weeks, as we've been talking about, might come into play. That could be a great cure to the disease that has maybe had some demand destruction up in these prices. All right, so remember, trading futures involves risk and is not suitable for all investors. And everything I talk about here today is just my own opinion and not a direct trade recommendation. But if you are looking to turn those into direct trade recommendations or work with a broker, check out the links below to sign up for our daily newsletter from our whole team over here at Zaner. It's completely free. Or join me tomorrow at 2 p.m. on Thursday, and every Thursday. Sign up in the link below to get and be a part of that Strategy of the Week webinar, where I'll go over some more actionable trading strategies to take a look at. Last week we looked at some put ownership in corn and beans, how we could still get that done and have a cost valuation on those puts that would protect us still above the $5 threshold and above the $13 threshold for corn and beans respectively. And of course, now that the market's headed lower, you'd have to fight to be able to get something done like that. Let me flip back to that the other charts here, because I think I do want to look first and foremost at November beans and the decline we've seen here today. I guess let's start with soybeans. Broken trend line against the lows of July through the lows that took us up in that WASDE report day in August. That broke last week. We traded lower. We traded back up to test that as resistance. We fell below each one of our moving averages. The 18-day is now at 1327, the 55-day at 1337, and the 100-day at 1352. We've talked about the 200-day moving average, which is down at 1254 at this time, and that prior low that we've also talked about for the month of June down at 1240. Seems like the market's coming down to test those levels. Drawing an aggressive trend line against the lows of June through the lows of last week. We broke below that level here today, and I would look for that area of resistance. It's 1285 to 1290 now on a bounce back to test that level as resistance. I think we're starting to get that move here into the end of the day. We'll look at the smaller time frame charts and take a look at where some resistance might be to hop in on this downtrend if it continues. Again, bigger level below us too could be this confluence of support and resistance that we had to start the year. It was basically the fight we had, let me move the chart over a little bit, to break above $12 early on. We fell back, we finally broke through, we tested $12 as support, and then followed a $2.80 rally up to highs of the year. The $2.40 pullback off of the 1480 highs down to the 1240 lows, extend that from our highs of this range that we were forming over the last couple months. That could lead to a pullback, as we'll look at the 4-hour chart in just a minute, to take us down below $12 as well. So if we don't hold support down in the 1250 to 1240 area, I am in the camp that thinks we might go down to test $12 and maybe even below. Why, Dan, could this happen at this time of year when we see fundamentals suggesting that we're going to have really tight balance sheets? China's been buying beans here hand over fist in exports, but notice that has gotten very quiet here now that the marketing year is over and we're into a new balance sheet. China has been very quiet. Obviously, we've got NOLA and the New Orleans port kind of in a shutdown right now because of the hurricane. That's not helping. A stronger, relatively speaking, dollar than we had early this year isn't helping. And to be fair, China's probably in here selling the board futures while simultaneously buying that cash, putting a hedge on their position so that if the board breaks like this, price action that they could actually, with enough oomph, drive lower. It's really hard to drive cash prices lower if the demand in the carryout is as tight as it is. You have to pay up to get the beans out of silos right now in the cash market. And same thing for corn. That's not true in the board. You could sell the board, funds could sell the board and drive price down just because there aren't enough buyers on the board right now. So the futures price drops as a hedge. They buy back that hedge and create a harvest low on the board. They use that cost difference between where their cash price was and whatever they made on the short futures, and they've now cost averaged that cost, the cost of acquiring U.S. grain to a lower price point. So soybeans, we're going to start on a 15-minute chart just because that's what I have up here. Lows of the day are no particular level other than 1270. Great level, and no particular reason why we bounce from that area, in my opinion, at this time. But we are coming back to test the lows of August here at 1277 into the end of the day. So trading back above that level is certainly nice to see, but there's going to be lots of resistance. Trend lines against the highs now. Again, the 1285 to 1290 area is where I peg the next kind of resistance zone. Yesterday, we had a little bit of a box here. I thought we'd get as high as 1298. We only got to 1295, so that area certainly found resistance. We sold off, went down to the negative 23.6% lines, almost made it to negative 61.8 line, and found some short covering here into the close. The next in a series lower, if this market is just stair-stepping lower, just draw a fib from the highs of today to the lows of today. That is now a 50% retracement, would take you up to 1282. That's a 50% retracement on the day and for the month of September now. It would also take you right up into that trend line resistance we have against the highs. So from a technical standpoint, this market is just trending lower. making progress lower each and every day here. You can't ignore that a full 50% retracement from the 1340 highs down to lows at this point could get you up and test around that $13 mark. I don't necessarily see the market's ability to get up there just yet. There's some other levels we need to chew through to get there, but you can't deny that soybeans will do what soybeans want to do. So again, into tonight's overnight session, my first resistance I'm looking for, it's also lows of yesterday. It's a confluence or of a congestion zone, I should say, from early morning price action today that we ended up breaking below. And again, the 50% retracement on the day and where trend lines are. So the 1282 to 1290 area to the upside, just because that was our original trend line, but I think it would probably hold more aggressively down here around 1285 before turning lower. This next leg down, however, when we take a step out to that 4-hour chart, gets a little bit more dramatic because now a move below today's low could potentially break even lower and take us down towards that 1240 low. Now we're starting to get into territory that we only spent a few moments down into earlier this year. And again, below that level really opens the door to retrace that big move up we had at the end of April or March at the start of April, where we traded very quickly through and higher. We could easily slide back down through that level very quickly. And that's potentially the type of level that could cause that capitulation, create a low somewhere down between $12 and $11.50, give us that a reason for demand to come back into this market and a reversal to happen. So as we're rolling over here, I fear that may be what's finally happening. And again, from the original 1380 highs down to the lows here at 1277, we had that 50% area at around 1230, held all of last week. 3 tests of it, couldn't break through. So now the market has fallen. We've broken below that 1277 low. This has all the hallmarks of a market that's wanting to trend and head lower for a little bit here. And that's what we need to really concentrate on and be aware of. So again, in the short term, watch for this channel resistance somewhere between the 1280, right around 1285. I feel like it's going to come in. But every day here on these breakdowns, it hasn't quite made it that high. So we'll see what happens here in the overnight session. But certainly below 1270, not much in the way of catching us before that 1240 area. All right, so for December corn, and then we'll look at wheat here too today because I think there's an interesting development, particularly because the price or the spread between corn and wheat right now has gotten almost $2 wide. Somebody's a liar there, and with the rest of our row crops heading lower, wheat just seems I don't want to say overvalued because we have very tight carry out there from tight production this year, but wheat definitely seems like it may be destroying more demand up here. Every day we spend above $7. So December corn, like our soybean chart here, has trend line support that continues to unfortunately falter for us. That trend line support, kind of no matter how you draw it here, is getting tested and might want to break. The lows we held today did come down right into, if you draw a trend line from 526 through the low here at 7.9 in this range, did come right down into that level. My fear, though, is that if you go a little further back, you start drawing trend lines from previously on this chart that arguably could have gone, you make a good case, go all the way back here, starting in last November. We broke below that level here today. And yesterday, we broke that trend line and closed back right at it and talked about how that could have been a fake out yesterday. Today's price action, though, I think erases any of that hope. Trend lines against the highs now you have to be aware of that we could be holding. And, of course, resistance from those would come in around 540. We're below the 550 55-day moving average, below the 550 600-day, and below the 552 18-day moving average. And that 200-day moving average is down around $5. We go down there to test that level. We're testing the low end of the range. And again, we have that open gap that aligns with the high end of our, that similar area that we looked at of congestion that we broke out of. We broke above the 450 mark, went to test it, failed it. We went through it, came back to test it as support, here in March and then went on a $2 tear up to basically 650 highs. We have an open gap there, 477. So this market starts to slide below the 420 mark, below $5. There's a good area of confluence that could catch it between 477 and 450. That just like beans going down to $12, 11 to 1150 could be the same type of area to consider on these charts. I know we've looked at all of these every day and they're getting old, but for those that are new and joining us here, want to make sure you're aware of where and how we come to this consensus. So again, that trend line we broke below and we're holding below comes in around 540. You can't ignore that every time you draw a trend line on this chart, we go below it, it comes back up to test it as resistance, broken support as resistance. Trend lines against the highs now. That similar area that we talked about in soybeans comes in for corn, somewhere between 525 and 530 on this chart. 525 just because that is the 50% short from mid-session today, the 530 highs to lows. I personally think that unless we head straight lower on the open here tonight, we probably will get a move back up towards 527 to test that trend line resistance, as well as the 50% level from the highs of the day, also the highs of the month so far, down through the lows. That would be a test of yesterday's low as well, and as well as that congestion zone that we were holding there around the open today. The full 50% retracement from our most recent 558 highs to lows after could give us a little bit of resistance at and near the highs of the month at this point. So I think that the next area of resistance we'd want to be aware of would be a retest of that broken trend line now as resistance. It would also take us up to a 50% area of 558 highs down to the 518 lows. And again, would be a retest of our highs for the month, somewhere around 536 to 542 at this time. Above that area, we're going to have this trend line from the 594 highs through the highs of this week, and that would come in around 547. So lots of levels that now corn would have to chew through back to the upside in this range. And we didn't quite make it in the rally from the 594 high down to the 530 lows. We didn't quite make it up into that 50% retracement. That's fine. Sometimes markets don't quite make it there. Moving out to our 4-hour chart, the old trend line that was drawn through the highs that we failed to break above on that WASD news spike, that comes around 555. So this market has been holding and been like a magnet back to 550, 555 area in December corn. I'm not so certain it has what it takes to get back there again and again, but where support came in, you can't argue that that is simply the low end of the range so far and has been for the last several months. So we would need to see a pretty convincing snapback and move back towards 540 to 550 to regain for the bulls to regain this chart at this time. There's an important level, though, that we are kind of below here, and it aligns with where that short term or the first resistance I mentioned in that 527 to 530 area is. It's the prior lows here that we're holding pre-WASD. It's the lows we held after that WASD in that retest of August lows, or the new August low that then we broke below. Now that September's price action has gone below this 532, to 527 area, I'm bearish below that kind of line in the sand. We get above there, we can start talking about retesting and coming back up to 550 to 555, the middle of this range. And if we get there, there's probably a really good chance that we're going to get all the way back up to 570 to 580. But you can't argue with the multi-day downtrend we have now setting in. The lower lows and lower highs for 3 days going now. The trend line resistance that's on this chart, and that is matched pretty well with what we see on soybeans. All right, and now in wheat, we can just hop. Let me actually see if there's anything. Yeah, I guess we could quickly look at where the longer time frame moving averages here are for Chicago wheat. And keep in mind here, Chicago wheat has been in a range between this 760, 780 area and these low sixes. The 200-day moving average down around 665. The 155-day moving average is right around $7. So if we start to slip and go below 7, it's going to give us a bearish crossover, or what we refer to as a death cross of those two. And of course, the 18-day moving average, we're now below at 740, probably going to be resistance here on any kind of rally as well. Want to really, though, look at the 4-hour chart here for Chicago wheat, because we have what I would refer to as a head and shoulders pattern. Left shoulder here around the 747 area, right shoulder here around the 747 area, head around 786, excuse me. That neckline here at 720, we broke below it yesterday, came up, tested it as resistance here today, failed to break above it, and went right back down. We break below the lows here. I believe that is beginning, in my opinion, a trend down. Testing the 665 lows from, 200-day moving average, as well as lows from July 26 would probably be the next area to think about. And then below there, we would probably get a test of trendline support down around the 640 area. So could have, a 70-cent slide here in wheat back down in the low end of its range. And by the way, that would bring that, corn to wheat ratio a little bit tighter, given that it's almost $2 wide right now. That seems a little wide for me this time of year. So with all that being said, I hope you've enjoyed today's Strategy of the Day update. I can always be reached over here at Zaner at 312-277-0110. Find me on Twitter, here on Facebook at Dan SOTD. Shoot me an email, dhussey@zaner.com. And don't forget to leave your likes and your comments in the section below. And do check out that newsletter we've got for you, as well as the Strategy of the Week webinar that I'll be coming at you with tomorrow at 2 p.m. Central. Have a great day, everybody, and we'll be back with you as price action develops.